Have you ever taken a trade that looked absolutely perfect, only to watch it hit your stop loss minutes later? The trend looked clean. Your entry was at the golden zone. Everything matched your strategy. So what went wrong? More often than not, the problem isn't your entry. It's that you're trading against the bigger picture. Take the British pounds against the US dollar 15-minute chart as an example. Price is clearly moving higher. So we draw a Fibonacci retracement over the latest impulse and place a buy limit inside the golden zone, expecting the pullback to continue the trend. Instead, the price keeps falling and the trade fails. When we zoom out to the 4-hour chart, the reason becomes obvious. The 15-minute uptrend wasn't the real trend at all. It was simply a correction inside a larger bearish market. Once that correction ended, the higher time frame trend resumed, taking our trade with it. Here's another example. On the 30-minute chart, the market is trending lower. A fair value gap forms above a liquidity zone, giving us what appears to be a textbook easy short setup. We enter the sell trade. Price reacts briefly, then reverses and hits our stop loss. Again, the setup wasn't necessarily bad. Now let's zoom out to the daily chart. As soon as we do, the problem becomes obvious. Price has already reached a major daily support zone. Every time the market has traded around this area before, buyers have stepped in and pushed price higher. So although the 30-minute chart is still showing bearish momentum, that momentum is running straight into a level where demand has repeatedly taken control. Selling here means you're expecting sellers to break through a level that has already rejected price several times. That's not impossible, but it's definitely not where you want to be opening a fresh short position. Both examples teach the same lesson. A good setup on a lower time frame can still fail if it goes against the higher time frame market structure. Fortunately, avoiding this mistake is much simpler than many traders think. You don't need to analyze every chart from the monthly all the way down to the 1 minute. In fact, using too many time frames usually creates conflicting information instead of clarity. For most strategies, 3 time frames are more than enough. In this video, I'll show you how to use higher time frame analysis to identify the market's overall bias, align your trades with the bigger picture, and avoid setups that have a low probability of succeeding. Before we get into the chart examples, let's quickly define the role of each time frame. Your main time frame is where you build the trade idea. This is where you analyze a market structure, identify trends, locate liquidity, mark supply and demand zones, and define your trading area. The lower time frame is only used for confirmation. If you've already identified a demand zone on the 1-hour chart, you can drop to the 5-minute chart and watch how price reacts when it reaches that area. A strong rejection wick or a double bottom can provide extra confidence before entering, but it shouldn't create the setup itself. The higher time frame has an even simpler job. Its purpose is to show the overall market direction and identify major support and resistance levels that could influence your trade. The strongest setups happen when these time frames work together. If the higher time frame is bullish and your main time frame is also bullish, you're trading with the dominant market direction instead of fighting it. Now let's look at why higher time frame analysis is so important. The first reason is that higher time frame levels carry much more weight than lower time frame levels. A daily support or resistance zone represents a much larger market decision than one formed on a 5-minute chart. That's why even a strong trend on a lower time frame can reverse the moment it reaches an important daily level. For example, imagine the Euro-US dollar is trending higher on the 30-minute chart. Everything looks bullish until the price suddenly rejects the same area twice and starts falling. If you only watch the 30-minute chart, the reversal would seem unexpected. But when you zoom out to the daily chart, you discover that price has reached a major support and resistance level that has already produced several significant reactions. The higher time frame level overpowers the short-term momentum. This is why you should always ask yourself one question before entering a trade. How much room does the price have before reaching the next major higher time frame level? That simple check can help you avoid buying directly into resistance or selling straight into support. The second reason is identifying the macro trend. One of the highest probability situations in trading is when the lower and higher time frames agree. Imagine you see a bearish structure forming on the 15-minute chart and immediately decide to sell. Without checking the higher time frame, you may not realize that this move is only a temporary pullback inside a much larger bullish trend. Once the correction ends, buyers step back in and the overall uptrend continues, stopping out anyone who sold the pullback. When your lower time frame setup aligns with the higher time frame trend, you're trading with momentum instead of against it, which naturally improves the probability of success. The third reason is filtering market noise. Lower time frames contain plenty of false breakouts, liquidity grabs, and short-term swings that can easily trap traders. For example, a breakout below a recent low on the 5-minute chart may look bearish, but if the daily trend is still strongly bullish, That move could simply be a liquidity sweep before price continues higher. Knowing the higher time frame bias helps you ignore those misleading moves and focus only on setups that support the broader trend. Now that we understand the theory, let's see how to combine multiple time frames in practice. A common mistake traders make is believing that analyzing more charts leads to better trades. So they start on the monthly chart, move to the weekly, then the daily, the 4-hour, the 1-hour, the 15-minute, the 5-minute, and sometimes even the 1-minute. Instead of gaining clarity, they end up with conflicting signals and analysis paralysis. A much simpler approach is to use no more than 3 time frames. For this strategy, we'll use the 1-hour chart as our main analysis time frame, the 4-hour and daily charts for higher time frame context, and the 5-minute chart for entry confirmation when needed. Each chart has a specific purpose. The higher time frames tell us the overall market direction and highlight major support and resistance levels. The 1-hour chart is where we build the trade idea, and the 5-minute chart helps us fine-tune the entry once price reaches our trading zone. Let's see how that works in a real example. We're looking at British pounds against the US dollar on the 1-hour chart. The first thing that stands out is the market structure. Price is consistently making higher highs and higher lows, giving us a clear bullish trend. Since the market is trending higher, we're only interested in buying. Selling against this structure doesn't fit our plan. At the same time, we don't want to chase price after a strong impulsive move. A pullback offers a much better opportunity. So where should we expect that pullback to end? Looking at the latest impulse, we can see a fair value gap left behind during the rally. The candle that created this imbalance also gives us a logical order block, making it a potential demand zone. To add another layer of confluence, we draw a Fibonacci retracement over the same impulse. Notice how the order block sits inside the golden zone, between the 61.8% and 78.6% retracement levels. Now we have multiple reasons to pay attention to the same price area. Instead of buying immediately, we'll wait for the price to retrace into that zone. Before placing the trade, though, we need to check whether the higher time frame agrees with our analysis. Let's move to the 4-hour chart. Remember, we're not repeating the entire analysis. We're simply looking for 2 things. First, what's the overall trend? And second, are there any major levels that could interfere with our trade? On the 4-hour chart, the market has clearly shifted from a long-term downtrend into a bullish structure. Price is broken above previous supply areas and key resistance levels, showing strong buying momentum. So the higher time frame confirms the same bullish direction we saw on the 1-hour chart. Next, we identify the nearest key levels. Price has reacted to several support and resistance areas recently, but the closest major resistance is still well above the current market. That's important because it tells us there's enough room for our long trade to develop before running into significant selling pressure. With both time frames aligned, our trade idea becomes much stronger. Now we return to the 1-hour chart. Some traders would simply place a buy limit inside the order block with a stop loss below the zone. That's a perfectly valid approach, but if you want extra confirmation, this is where the 5-minute chart becomes useful. As price enters the trading zone, we watch for signs that buyers are actually defending the area. That confirmation could be a strong rejection candle with a long lower wick, or any clear bullish reaction showing that demand is stepping in. Once we see that reaction, we enter the trade. The stop loss goes below the rejection, but not so tight that normal market fluctuations stop us out prematurely. By combining multiple time frames, we've created a complete trading process. The higher time frame gave us context. The 1-hour chart identified the setup, and the 5-minute chart refined the entry. Instead of relying on a single chart, every decision is supported by the bigger picture. Now let's look at a trade that appears perfect on the 1-hour chart, but becomes much less attractive once we check the higher time frame. This time we're looking at the Euro-US dollar on the 1-hour chart. The market is clearly bearish, forming lower highs and lower lows. The latest impulse leaves behind a fair value gap, and just above it we have a set of equal highs, meaning buy-side liquidity is resting above that level. This creates a classic smart money setup. If price retraces above the equal highs, and then sweep the liquidity, and reaches the supply zone that created the imbalance, we'd have a strong area to look for a short position. So we mark the supply zone, place a sell limit inside it, and position our stop loss above the zone. Everything looks like a textbook. If you only analyze the 1-hour chart, there would be very little reason to question the trade. But before committing any capital, let's check the higher time frame. On the 4-hour chart, we immediately notice something important. Price has just reached a major support level. This isn't just a random area on the chart. It's a level where price has reacted several times before, producing strong moves away from it. That tells us buyers have consistently defended this zone in the past. Now price is testing that same level again. Even though the 1-hour chart remains bearish, the higher time frame support increases the probability of a bullish reaction. That changes everything. Our short setup is no longer trading with clear momentum. Instead, it's moving directly into an area where buyers may step in and reverse the market. This is exactly why higher time frame analysis comes before execution. A setup can look perfect on your main time frame, but if it's running into a major higher time frame level, the probability of success drops significantly. Let's see what happens next. Price retraced back into the supply zone and triggers the sell entry. At first, the trade looks fine. Then buyers begin defending the higher time frame support. Price rallies through the supply zone, breaks above the stop loss, and continues higher. The pattern wasn't the problem. Ignoring the larger market context was. That's the key lesson from this example. Higher time frame analysis isn't just about finding better trades. It's also about avoiding trades that look good but have poor odds because they're fighting the broader market. Sometimes the best trade is simply the one you don't take. Multi-timeframe analysis doesn't have to be complicated. In fact, keeping it simple usually leads to better decisions. That won't eliminate losing trades. Nothing can. But it will help you avoid many low-probability setups and focus on the opportunities that have the strongest confluence. And over time, that's what leads to more consistent decision-making. If you found this video helpful, don't forget to leave a like, and let us know in the comments what trading topic you'd like to see next. Thanks for watching, and I will see you in the next video.